Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended February 20th, 2019. I think some investors may be surprised to see that we had outflows about $12.1 billion from the conventional fund business. This is when we had a really strong market return. NASDAQ was up over 2%. S&P was up about 1.5% in that area. So really we had to look at kind of the reasoning what scared off some investors. And I think most people were keeping a keen eye on the China-U.S. trade talks that have been going on. It was over in Beijing for a while. This week it transferred back over to the United States and in Washington, D.C., obviously. And I think what really threw people off and put them back on the heels is they heard kind of rumblings that there's a possibility that the European counterparts in the automobile industry could suffer export, or in our case, importing from Europe, some tariffs coming into the United States on automobiles. And until we get some definition on that, I think people were just ready to take a wait-and-see approach. Let's go see how this news impacted our macro groups. Take a look at equity funds. They handed back about $3.5 billion. Taxable bond funds took in $1.8 billion. So we see that the kinder, gentler Fed is working out in that area. Muni bond funds took in about $1.4 billion. I think it's the fourth or fifth consecutive week we've actually seen billion-dollar inflows into muni bond funds. I think we're like on the eighth or ninth consecutive week of actually having inflows, but over $1 billion in that case. And the last that we mentioned, of course, is money market funds. They saw about $11.7 billion in outflows. Let's go ahead and take a finite look at the macro group separately. Let's take a look first at equity funds. The equity fund arena actually saw a 1.44% return. I told you it was good. Eighth consecutive week they've seen plus side performance, but we see for the first week in 7 they handed back about $3.5 billion. Domestic equity funds basically lost about $2 billion. The fifth consecutive week that they've seen outflows, but we see that for the 8th consecutive week, plus side performance, this time to the tune of 1.37%. Non-domestic equity funds handed back about $1.5 billion. First week in 7, they've seen net outflows. But for the 7th week and 8th, they actually had plus side performance 1.60%. So a little bit of a head scratcher on why that occurred, that we see these outflows. But if we take a look at the focus look, we see that large cap funds handed back about $1.4 billion. And we see that international equity funds handed back about $1.1 billion. So a little bit of storyline there. If we take a look at the equity arena, it's a little bit different there. We're actually seeing plus side performance and plus side flows. So for the second consecutive week on ETFs, we see that they took in money, this time to the tune of $1.7 billion. At the top of the universe, we see that Invesco QQQ Trust 1 took in about $1.3 billion. And then the iShares Edge Minimum Volatility USA took in about $675 million, and then we see SPY, S&P 500 ETF actually lose about $696 million. And then if we take a look at the very bottom of the universe, we see that consumer discretionary select sector spider funds lost about $553 million. So overall, again, we see that the ETF arena actually added money while mutual fund investors actually basically were very risk averse. Let's go ahead and take a look now at our fixed income arena to see what happened with that group. Fixed income funds for the 6th consecutive week took in money. Again, at kinder, gentler Fed. The curve shifted up a little bit yesterday, but on Wednesday it still remained flat. And so I think investors were more sanguine on the market, less concerned that we're going to have rising interest rates, and more willing to go out on the curve a little bit. So again, $1.8 billion. 8th consecutive week, they've seen plus side performance, this time to the tune of 0.51%. And the big attractor of investor assets were corporate investment grade debt funds, took in $1.4 billion. Government mortgage fund only took in $234, but that was the next group. And then international and global debt funds were the only group suffering big outflows, and this time to the tune of about $706 million in outflows. Let's turn our attention now to the ETF arena, and they were more in line with their retail investor group. So we saw about $1.2 billion in net inflows into that group. 4th consecutive week they've seen net inflows. And at the top of the group is iShares 7 to 10, so they're willing to go a little bit longer on the curve now. Basically, we see the iShares 7 to 10 Treasury Bond Fund ETF taking in about 804, excuse me, and iShares Mortgage-Backed Security MBS ETF taking in about 357. At the bottom of the barrel, we see iShares 20-plus year Treasury ETF losing about 354, and iShares 1 to 3 Treasury bond handing back about 200. $352 million. So not a lot to talk about there as far as the downside. But again, we see that the retail investor and the authorized participants, the ETF investors, were in line or in two with each other for fixed income funds. Let's turn our attention now to the muni bond fund group. And as I said, we've seen net investments into that group for the seventh consecutive week, $1.4 billion this time. And again, we've seen a couple, 3-4 weeks in a row where it's been over $1 billion. So there is a trend there. Obviously, we're entering tax season. Maybe it's just people are thinking about that. Fourth consecutive week, though, we've seen plus side performance, this time to the tune of 0.16%. So not a lot to talk about there. But the main attractors of money were the general and insured muni debt funds, taking in $399 million, and high yield muni debt also took in money, about $397 million. And if we take a look at the ETF side of the arena, we see that there was small inflows, about $95 million. So again, they kind of stayed in line with one another, the retail investor and the authorized participant. Let's go ahead and turn our attention to the last group, and that's money market funds. Money market funds for the first week in three saw outflows. This was $11.7 billion in outflows that we had. If we break this down, though, we see taxable money market funds handed back about $12.1 billion, while tax-exempt money market funds actually took in $377. But breaking down the taxable money market fund groups, we see institutional investors pulled out about $16.8 billion, while the retail money market funds actually took in about $4.7 billion. So that was kind of the story behind the money market funds and the money market arena. Now, we are now, looking at, again, the news today. We see that there was some, I would say, discussion that was a little bit more disappointing on the China news area as far as, getting that agreement going. Trump actually tweeted out and said, maybe we'll do the deal, maybe we won't. Somewhat cavalier. But I think, though, both sides, both the premier and then the president from China and the U.S., respectively, they have decided to try to work a little bit longer. So rather than ending the meetings today on Friday, they're going to go ahead and actually add another 2 days to see if they can get some deal hammered out as well before the tariffs jump from, I think it was from 10% to 25%. So I think people are motivated to do that. So we'll keep an eye on that. But basically, if I have not done a deep enough dive for you and you wanted to do a deeper dive yourself, you can go to our site at www.usfundflows.com. LipperUSFundFlows.com, or you can join us next week where one of our analysts will talk about the trends of the flows industry for that week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.